bit of background. I'm Greek-American. I run a consulting firm called Navigator, which is based in Greece, in Athens, in London, and in Nicosia, Cyprus. We're focusing on due diligence, feasibility studies, business planning, etc. for banks, manufacturers, other investors. We were founded in 1995. I'm one of the three founders. Since then, we've led about 4 billion in primarily manufacturing and tourism investments in Greece, but also in emerging economies. So we have a lot of experience in very basic assessment of business opportunities, of debt levels, of debt refinancing, etc. So my perspective is very much a microeconomic perspective. It is a practical, practitioner-oriented perspective, and I hope it will be interesting, and I hope it will add to our debate today. Okay, so let's look at Greece in some more detail. And let's start out with the origins of the public debt crisis. And as Miranda has said, this is a crisis which has been a long time in the making. The numbers have been visible to all concerned. And beyond the official numbers, pretty much everyone has known that there has been a set of unofficial numbers involved. And it's that set of unofficial numbers which is now being consolidated to the official public debt and which is causing such a shock in statistical terms. Let's look at the gross public debt, which we can measure both in terms of billions of euro as well as in the debt to GDP ratio. I have here the Eurostat statistics downloaded earlier this week. There are some problems with the statistics, which I will describe in more detail a little bit later on, but let's rely on these numbers for the time being. We see that in 2001, when Greece was led by a center-left socialist government, the debt was about 150 billion euro. And by mid-2010, it had risen to, and the Eurostat numbers, 328 billion euro. This is an amazing amount of money for a country with 11 million inhabitants and a GDP of about between 230 and 220 billion at the present time. As we can see, even in 2001, at Eurozone entry, the debt to GDP was 106%. So in no way did Greece correspond to the Maastricht criteria, although there was some progress observed. The problem was that after Eurozone entry, there was very little pressure on Greece to comply with the criteria, or in fact, any other country. Now, there is a high public debt for a reason. And this reason is basically the model of state-led development. I'm not going to bore you with academic theories or whatever, but to summarize, in Greece, traditionally the state has led development. So it's been the government which decides where the highways go, where hospitals are built, where universities are built, etc. And the government is the primary controller of and financing channel for these investments. Now, to some extent, this is justified. Greece is not a rich country, despite what you might think on the, on the superficial level. After World War II and the Civil War, which followed, Greece was literally destroyed. The country literally had to be rebuilt from scratch. My mother, who is Greek, was born in a village in the mountains of central Greece, which had no electricity and no running water until 1962. And I'm sure in Spain you might have equivalent regions. We're talking about a country which has really had to invest a lot, and it's had to invest even further because it's in a very geographically isolated position. Greece's neighbors are not France, they're not Belgium. Greece's neighbors are Albania, Bulgaria, Turkey, which are not, and were not until recently, consumers of Greek products. They were in fact competitors of Greece. So we didn't have very many adjacent markets which could help with economic development. This is not an excuse in any way. I'm just mentioning some basic facts. We see that in the per capita GDP, according to the Eurostat figures. In 1995, when I've started this sequence, the per capita GDP was 8,000 euro, below that of Spain. And in 2010, we've managed to reach a level just about 20,000 euro per capita. So there's been a lot of positive development in the past 15 years. The problem, though, is that this development has been managed through the government and B, financed by debt. And I think we see this very clearly in this chart. The red curve is government expenditure, and the blue curve is government revenue. So the gap in between that is deficit spending, and those deficits have been funded primarily through debt. Now, other deficits have been funded in a few more creative ways, which we don't need to get into right now. But the primary method of financing this development has been debt. And when Greece entered the Eurozone in 2001, basically its challenges became very clear. The challenge is not the market. The challenge is not the region. The challenge is not the heat or whatever. The challenge is the fact that we do not have competent managers. We do not have efficient and effective governance. And this is a problem which we share with many countries. And what's interesting for me is I pay very close attention to public affairs. There is practically no ideological difference in the electoral promises made either by the left or the right. Right? If you look at what the left says, they want good schools, a solid pension plan, pension reform, better healthcare, etc. You look at the right, they say exactly the same thing. The problem is we've been saying this for generations now. We're still not Singapore, right? So there's a big gap between the perception and the political promises and the reality that's been delivered. So we claim that we want world-class development. Our political class insists on this, and the electorate follows it. But we are not prepared really to pay for world-class development, and we can see this most clearly in our commitment to tax compliance. I've done a quick division here using Eurostat criteria. I've divided the general tax revenue in Germany, Spain, and Greece by the population. So that gives us government tax receipts euro per capita. We see that in Germany there's been a fairly steady 10,000 euro per year in 1999, rising to 12,000 euro per year in 2009. In Spain we see a big increase. In Greece we see an increase, but more importantly this is only half the level of Germany. Now, we can of course make the case, sure, but Germany has higher profit, it has exports, etc. It didn't always have higher profit. The German public sector workout began in the early 1990s with the Treuhand, with the absorption of Eastern Germany, etc. And for a long period of time, if you read back issues of The Economist, it was Germany that was the sick man of Europe. So these numbers, as deceptive or as not comparable as they may seem, have some basis in reality. The fact is we want development, but we're not prepared to pay for it. And we exhibit this symptom through tax evasion and tax avoidance. And I think this is a simple fact which every political party has recognized, and certainly is a center point of the Troika structural adjustment program in Greece. Now, by 2009, the good times came to an end. The Dubai sovereign debt crisis broke out. There was a fairly immediate contagion effect within 6 months to Greece. So Dubai started in the fall of 2008 after Lehman Brothers. By early 2009, the first indications that there was a crisis were clear, and these reached a high point after the election in October 2009, when the new socialist government took power. To make a long story short, our debt today, if we believe the Greek figures, the Public Debt Management Agency's figures, is 340 billion euro. It is not the 328 billion with Eurostat. On the one hand, there are some differences in the accounting, in the statistical standards, but on the other hand, there's also a question of debt consolidation. For me, this is the first time that Greece has fully consolidated its debt. That means not just the central government, but the semi-governmental organizations, the pension funds, hospitals and other social organizations, etc. This has never been done before. If we were to do it today in the United States, I fear very much that our debt to GDP level might also be 120 to 130%, right? We know that the US official debt to GDP is about 97, well, it's basically 100%, but that is only federal debt. It doesn't include the bonds held by the Federal Reserve, that's 1.2 trillion. It doesn't include Freddie Mac and Fannie Mae. It doesn't include state debt. It doesn't include future Social Security deficits at the state level. So I feel really that we're at the forefront of one of the market crashes or bubbles that we see now, busts that we see now, which is a sovereign debt crisis. But unfortunately, I see that many other countries, although they are trailing us, will soon be roughly in the same situation. I hope I'm being pessimistic. I've been trained to be pessimistic, or conservative, as we say. But something tells me that it's probably not pessimistic enough. We have mentioned the problem of unreliable public debt statistics. This is due to a number of factors. I'll touch on them very briefly. For years, hospitals, social security funds, public enterprises have not had regular budgets, and the budgets have been between 2 to 4 years have been delivered after the current year. So if this is if financial year 2010 has just ended, many of these enterprises were delivering their financial results for 2008 or 2006. That is not changing, luckily. Many semi-governmental organizations, like State Railways Organization or the armaments companies, have essentially functioned as special purpose vehicles for debt. They have been able to raise debt on the credit markets using government guarantees, but this debt has never been consolidated to the central government balance sheet until now, until 2010. We know that the government cash flow is on a far worse basis than the official numbers say. And for me, for any business person looking at the balance sheet of a company, this is a main problem. If we see that the government has an 18-month delay in VAT reimbursement, a 20-month delay in paying construction firms or pharmaceutical suppliers, we can tell that there is a serious problem which is concealed by the official statistics. And finally, the problem which Eurostat has investigated, and I hope corrected, is that Hellenic statistics has essentially been part of the political system. There are different versions of this argument, but I want to point out that today, in May 2011, the statistical problems have still not been solved. I don't mean that there's further debt. I mean that if today you wanted to find out how many tourists have arrived in Greece in 2010, you cannot find the number. If you wanted to find out how many companies have opened or closed, it's very difficult to find the number. Without good statistics, we cannot have effective governance. And there's still a lot of work here that has to be done. We have many cases in Greece of arrested development, tourist investment. Major investments have been blocked for 10 or 15 years because of licensing, zoning, environmental regulations. You cannot operate a private university in Greece at the same level with the same acceptance as a public sector university. Waste management is a public monopoly. They're doing a horrible job of it. We have among the highest number of environmental violations of EU law, but at the same time there is almost no room for the public sector, for the private sector to invest in this area. So we have areas which have been blocked, they've been frozen, and hopefully now they will become unfrozen. That's my hope. We've had years of misallocated resources. Our State Railways Organization, OSE, is the most indebted company in Europe, a public company that has a debt of 10 billion euro. What is amazing to me is that despite all of the problems that we see in this company, the EIB turned around last year and gave it a further loan of 1.1 billion. I would never have given a loan to a company which I consider to be a candidate for liquidation, not restructuring, liquidation, or privatization, whatever you want to call it. Another example, we have an agricultural sector, which of course is governed by the Common Market Organization and by common agricultural policy subsidies. It's less than 4% of our GDP. It received over 2 billion euro in subsidies in 2009. If we take the tourism sector, which is 20% of our GDP, according to the wider World Travel and Tourism Council definition, that received only 200 million euro in spending. There's a total misallocation of resources. Let me ask you a simple question. When is the last time you've ever seen an advertisement for tourism in Greece, here in Catalonia? Probably not very frequently. When is the last time you've seen something for Croatia or Turkey? Probably much more frequently. Unless we invest in the mainstays of our economy, the future of our economy, There is simply no way we're going to recover from this crisis. Unfortunately, this lesson is still not entirely learned in Athens. One of our major problems is that we have barriers to employment. So just as in Spain, in the whole of Spain, I hear that there's an incredibly high unemployment rate. In Greece, we've now hit 15.8 or 0.9%. The main barrier for me is not the lack of work opportunities. It is the fact that the combined social security tax for the employer and the employee is 44% of the wage. Now, I'm an entrepreneur and a consultant. I run, besides my consultancies, I run several startups. I am going to think very carefully about hiring people in Greece at this social security tax rate, especially if I know what I get back for the tax paid. Another problem is low employment. So here we're talking about the total employment of the labor force. Male employment, as you can see, Spain, Greece, Germany, they're very similar. The problem is female employment. In Greece, less than 50%, less than 50% of total females of working age who are not disabled are officially in the labor force. Now, I don't see how we can make progress if half of, our better halves are not working, or at least not officially working. Again, this is a structural issue. It has to be changed if we want growth. Unfortunately, there's still very little momentum and very few policy interventions in this area. I believe Spain is exactly the same system. You have a very rigid system of permanent employment. You have a very large or growing sector of temporary employment for young people. Clearly, this has to be changed in some way. We have high bureaucracy. I'm, as a company owner or a small business owner, I am in a health insurance or a public, a public system, a public fund called OAE, and I have to do this procedure every year, and so do about 1.5 million other Greeks. So I've got to go in the morning to the public authority. I have to stand in one line while some guy looks up on a computer and confirms that I've paid my fees. I then go into another line to choose the doctors that I'm able to see. I then go into a third line so that someone can enter this list of doctors into a computer. He then prints out a form. I go to a fourth line and stand in line to get a stamp from a supervisor. And then I go back to the third line so I can get a final printout in my insurance book. Now, this is absurd. Imagine if to pay your Visa card in a bank, you had to do this. There would be a revolution tomorrow. The technology exists, right? The systems exist, but for some reason, we're not adopting what should be very simple means of boosting productivity. And it's something we really have to if we want to, attract investment and grow. So these are some of the issues, some of the basic dimensions, some of the basic problems. I now want to look at the public debt and different scenarios for working out the debt on the base case. And the base case is essentially the policy interventions which have been described until now. Let's do very quickly a timeline of the crisis. The current bailout started in May 2010. We're talking about 110 billion euros split between the ECB, Eurozone, bilateral loans and IMF loans in exchange for structural adjustment and fiscal reforms. This is called the memorandum in Greece, and it's a form of conditionality. The memorandum is eminently rational. You can look at the conditions online. They are not something which is alien or economically or socially irrational. They're what any rational business person or household would do to reduce debt and to reduce waste. So the structural reform process started in 2010. The money is being dispersed according to evaluations and according to the conditionality. We are about halfway through the disbursement period, a little bit less than halfway through the total disbursements. In November 2010, Eurostat finally revised the Greek debt statistics, showing that public sector debt was higher than initially recorded. We knew this was on the way. We knew almost precisely where the debt was, where these differences were developed from or where they accrued to, and it was very positive for me that they finally did that. In March 2011, there was a second upward revision of the debt or the deficit because, again, there were late reporting by Social Security funds and hospitals. The Public Debt Management Agency, as I said before, now records total debt at 340 billion. Eurostat records it at 328 billion. So there's a small discrepancy in the total number. The basic magnitude, though, is clearly established. In March to May 2011, there began a process of further structural reform. This was pressed on Greece by the Troika, primarily because the numbers didn't really add up. And I'll get into that a bit later. This Monday, the Cabinet announced additional measures, 28 billion in operational savings and added revenue to 2015, and a euro 50 billion privatization program. And I'll look at that in a little bit more detail. That's been announced in the Cabinet. It has not all been voted. And even if it's all voted, we cannot be sure that it will be implemented. But at least it's really the first time since the crisis began that we're looking numbers of the right order of magnitude needed to address the problem. Now, the structural reform has gotten very negative press in Greece and very negative press internationally, but I am happy to say that it is working. The deficit fell by 5% of GDP in 2010. This was split between a 2.6% expenditure cut and a 2.4% GDP increase. Revenue increased 7% overall year on year. That's below the target, which was set by the memorandum. But we have to remember that Greece had a recession at least of minus 4.5% last year, 2010. So this performance is incredibly good, basically. There was a net reduction of 84,300 public sector staff, primarily through retirement. The government has undertaken to replace every 5 public sector workers with 1 public sector worker. And there have been wage reductions of up to 30% in the public sector. And that is primarily for the higher salaries in the public sector. Exports grew by 35% year on year between Q4 2010 and Q1 2011. Pension reform has been partially implemented. As Miranda said, it is not complete, but it's a very important first step. Some professions have been liberalized, although, in my opinion, this is it's a very superficial reform. The recession has been deepening, but theoretically shallowing out. So there are some very positive impacts, and from my point of view, it's interesting because it is the first time that anything approaching this scale could have been contemplated in Greek society. Well, maybe not Greek society, but at least among the Greek political system. So momentum is building. Different people will say, yes, momentum is stalled, you know, whatever. But let's remember, only 12 months have gone by. It is an economic recession, and some very important measures have been taken. There are, however, some problems with the memorandum, and I will go through these problems. I'm sure that different people will have a different interpretation, but I would just like to show you how I see it and the problems I see it just from the classical business planning or investment planning perspective. The first is that Greece was supposed to have a soft landing, so the deficit was supposed to fall from 8.2% in 2010 to 2% in 2015, the deficit, okay? Now, I'm just wondering, on the one hand, how Greece is supposed to return to the markets in 2013, 2014, if we're still running a deficit. It doesn't do much for confidence in the banking sector, given the current state of the banking sector, and given what I predict will be the sovereign debt problems which we're going to see in 2014, 2015. The second problem was that the GDP decline in growth forecasts have not been adequately measured past 2012 or 2011. So if you look at the original memorandum statistics, we have a forecast to 2015, which is difficult to evaluate the credibility of. It might be plus, it might be minus, but it has to be justified, and there is no real economic background or justification for it. And there is no provision for higher interest rates. You know, the memorandum was drafted at one point in time. We saw in Miranda's charts the increase in the bond spreads. I'm at a loss to explain how interest rates have been factored into the model. I'm also at a loss to explain how interest has been factored into the model. We see here on the bottom line, and I apologize for the small numbers, but I'll make the numbers available. If we assume a 4.1% interest, which is extremely optimistic, right? It's a deliberate low end estimate. We're still looking at 15 billion euro interest in 2011, 15.4 in 2012, 16 billion in 2013, etc. Now, the central government expenditure, or revenue, I should say, in a good year is something like 50 billion. So we're looking at a very high amount of interest added every year, which I don't see taken into account in the model. Now, it's true also that other things are not immediately visible. For instance, if there is a GDP increase, we might have higher tax revenue, so maybe it's factored in somehow. But if I'm looking at this from the banking perspective, I want to see the impact of interest accruals in this turnaround plan or this turnaround model. And I don't see it anywhere, in fact. The additional problem which exists today, and which is the reason for all of the short selling of Greece and the high bond spreads, is that the timing just doesn't work. Greece is supposed to return to the markets in 2012-2013 for at least 60 billion euro in funds, not covered by the bailout. Again, I don't see how that's possible if we're still running a deficit. If we were running a surplus, I would say, look, we've made progress, we've done the cutbacks, give us more money to continue the process. But if we haven't, and you know, I've run up against this time and time again in my private sector practice, you have no ground to stand on. No one is going to lend you the money, basically. No one in the private sector. So I think we have some basic problems with just the design of the program. Now, I'm not pretending to be the great expert here. I'm just looking, just analyzing this from the outside. If we look also then at the revised loan schedule, you might have heard that there was a victory for Greece and that the terms of the 110 euro bailout were revised. The problem again is that neither the Eurozone neither the Troika nor the Greek government have explained how the numbers are going to work. So I sat down and tried to plug the numbers into a spreadsheet. We have the disbursement, which we see in this line here. So the disbursement is set to occur over 4 years, 38 billion, 40, 24, 8 billion. We have on the top line the total debt balance, which includes the interest plus the dispersal. We have a grace period, which we know has been extended, but we don't know exactly when the loan repayments will start, but I'm assuming they will restart in 2014. If we assume a front-loaded equal installments to pay off the maximum amount of debt which will occur, we're looking at payments of 19 billion euro per year. Now that's just for the 110 billion that we owe. We also owe, in present value, 230 billion in private sector debt. Again, until the recent commitments undertaken on Monday, it was not clear to me how these numbers were feasible in any way. And I'm not trying to blame the IMF, I'm not trying to blame anyone else. I'm just saying, you know, we have a lot of commercial practice, we have commercial experience, we can't see how the model works, and I can fully understand why there is so much skepticism about Greece's ability to repay. Now, all this has led, as you know, through the Financial Times, the Economist, whatever, towards a new memorandum. And what has been discussed in the press is a second loan of at least 60 billion euro to cover the private sector spending shortfall in 2012-2013. The government on Monday announced, in exchange for austerity and privatization, so the government on Monday announced 6 billion euro austerity/revenue measures in 2011 and a further 22 billion between 2012-2015 and a privatization program of 50 billion. Now, this is really ambitious and it's politically risky, but for me it's the first time we're looking at any numbers, even if they're fictitious numbers, right? It's the first time at least the numbers make sense. right? Because the previous numbers, 7 billion privatization in the memorandum, didn't make sense, right? If our annual interest is 19 billion, 7 billion is less, it's about a third of our interest. So we definitely need to up our game a bit. We still have some challenges here. Even though this hasn't been published, we know that the repayment schedule is going to have to be extended. We know that the privatization is taking place against low valuations, and we know that there's huge political resistance. None of this is rocket science. It occurs in every country, and it will continue to occur in other countries where a bailout takes place. To summarize, a program of this magnitude has never been implemented. Now, I'm a very ambitious person. I would give it a 50% chance of success. Okay, if you were to tell me, okay, forget by 2015, by 2020, then I up the chance of success to about 80%. But in the next 4 years, we're looking at numbers which are, they're about as probable as, discovering life on Mars, basically. I've tried to do a model of the second memorandum, taking into account the assumptions made for the privatization revenue, land sales or leases, public sector cutbacks, new government revenue, etc. Up on the top we have GDP, and I've put in some basic assumptions of a 4% decline in 2011, 2% in 12, 0% in 13, and then a resumption of growth. Again, it's conservative. It might be better. We have our central government debt, which is 340 billion at the start of 2011. If we take the budget balance as planned by the memorandum, and if we implement it, we will have a 17.4 billion euro in deficit. We have to add to that about 14 billion in interest under the best case scenario, and 12 billion in privatization and savings, again under the best case scenario, which means that at the end of this year, we're looking at a debt, public debt of 360 billion, which is 165% of GDP. Okay? Next year, we take the same assumptions, we're going to hit 173% of GDP. In 2013, we're looking at 172%, and then it will start to decline, to taper off. But all of this, every single bit of it is essentially due to these numbers here. So we're assuming a low debt interest rate and achieving every single goal. And again, if you ask me, Philip, I'll bet you a bottle of champagne next year, or at the end of this year, I will bet against. Okay? Not because I have anything against Greece or whatever, I'm realistic. Now, some of the model upside, some of the assumptions, I've explained them here. Basically that any annual interest is at a rate of 4.1%. This is absurdly low. I've taken it because it was the last average interest rate cost in 2010, according to the PDMA figures. That any Troika bailout is going to roll over existing debt at face value. That any new income is used to pay down the debt. That because of privatization and restructuring, we're essentially reducing the deficit, but we're not generating necessarily new income because there has to be a debt workout and a restructuring procedure. Anytime a private enterprise buys a public enterprise in Greece, there's usually at least 2 to 4 years of really extensive restructuring. Also, GDP growth is unchanged, according to the prior forecast. Now, there's an upside to this. If we assume that this revenue is possible, not the expenditure cuts, but revenue, cash. If rather than taking that cash and redeeming the bonds at the face value, we redeem the bonds, we buy the bonds on the open market now, which means there's a 30 to 40% discount on the face value, we achieve a multiplicator effect. We're leveraging our leverage in a way. This is what's called an open market debt restructuring, and I would say that at least in the short term, it offers the highest chance of success of reducing the overall debt burden ahead of the natural rate of increase according to the interest costs. I don't know if this is acceptable. The ECB has very strange notions of how debt should be repaid. Logical according to their universe, but illogical according to the market. And I don't know if it's possible. Again, I'm a European taxpayer as well, right? If someone were to tell me, Philip, take 110 billion euro and buy 110 billion euro of bonds, I would say, you know, you're crazy. Because the 110 billion euro of bonds today, 110 billion euro of cash has a market value of 115 billion euro of debt. But again, because we're trying to preserve the European banking system, we're rolling over the debt at face value. We're not taking into account the market price. So I guess the European taxpayer should be content with this in a way. Very quickly, I want to run through my proposals, my company's proposals, for what we could do in a very short time period to deal with this crisis. And this is the second part of the title of the seminar, The Way Out of the Crisis. This is based on a lot of investment studies and analysis already done in Greece and what we know works from a couple of other countries with essentially the same profile as Greece. So I have 12 priorities here. There could be many more, but I want to give the 12 main ones. The first one is that the current public sector adjustment process has to continue. There should be no deviation from the terms whatsoever. Without these terms, it's clear that the political class, the political system in Greece will not make the changes needed. So stick to the conditionalities, pull your sleeves up, get to work, basically. Second of all, we're de facto looking at either a total default at the end of this year or expanding the bailout with an additional 60 to 80 billion in loans in 2012. If we do that, and I'll explain this in more detail, there has to be a voluntary restructuring by the private sector, and I'll show you how that can work. I would say that a portion of the bailout funds or any other resources gained through privatization should additionally, in parallel, be used for an open market restructuring, giving us a 30 to 40% acceleration or leverage to the buybacks. It's clear that the structural adjustment program has to be extended to 2020 at least, right? We're looking at 12 years of austerity, which if we also go for private sector investment, we can have a beneficial effect out of. And it's almost certain that we have to extend the grace period on the existing 110 billion euro bailout. There's simply no way that I see that we're going to be able to start repaying it in any substantial amounts needed from 2014 or 2015 onwards. Now, voluntary restructuring, we heard Dick Roche talking about this. So far, the private creditors have not suffered officially. In market terms, they've suffered, but officially they have not really paid for what's going on in Greece or in any of the other countries. So I believe that as a condition of any further bailout of Greece, there has to be a voluntary restructuring, kind of a Paris Club meeting. I would say that there are two options, and the option, I will only describe the first one because it's the only logical one, that the private creditors agree to roll over their debt at the existing maturities and interest rates. So if someone's bought a 7-year bond at 2%, he rolls it over. This has a cost for him, absolutely, because interest rates are higher now, risk is higher. However, it is the only real chance of achieving a realistic debt workout and not a haircut. In exchange for rolling it over in this way, I would say that they can exchange about 25% of their existing debt at face value. So if there's 230 billion in present value, 25% of that is about 57.5 billion. Presto, we're at that magical 60 billion number that people are talking about. It's an incentive. It's not bad if you can get 25% immediately versus trying to trade it on the secondary market for a 30 to 40% discount, or looking at the long-term prospect, which is a loss of at least 50% in a haircut. I think it also has to be made clear that any restructuring from 2013 and afterward has to include losses on bondholders, and it's too bad that we can't include the existing 230 billion, which is already out there. Now, privatization program. This is the list of companies which are to be privatized. The government shareholding and the market value. So down at the bottom, we're looking at a market value presently of about 6 billion. 2 years ago, that was something like 2 or 3, well, 3 times that amount, minimum. So we are trying to sell in a very adverse environment. And I believe that if we want to increase the value of these companies, again, we need time, but there's a way of doing it. And that way of doing it is basically a crash start investment program in Greece. That would be the quickest way of increasing investor interest and improving stock exchange values. Whether we're looking at privatization or investments, we need strategic investors. And here, our record of attracting strategic investors is mixed, but it has to be a condition of this privatization plan that we're looking at investors who bring three things to the table: know-how, capital, and market access. If they do not bring one of these three, I would say that they should not participate in the privatization. We have seen any number of capital-light investments, of venture funds, of equity funds, trying to make a quick return on a turnaround of a Greek company, and it usually doesn't work. The Greek environment is very complex, it's unique, and it needs a very well-capitalized approach to business. Also, we need professional investment management. We should not rely on side deals or pocket deals with Qatar or anyone else. We really need to promote this globally. We have, luckily, in Greece, examples of world-class companies. And this may come as a surprise to you. Here, I have some companies which are world-class in terms and have been developed either through privatizations or public-private partnerships. A simple example is the Athens International Airport. We have literally one of the best airports in Europe, both according to any sort of ranking, customer survey satisfaction, whatever, but also according to the increase in passenger traffic. We have some amazing indigenous companies that have grown through Greek investment, not foreign investment. A company you've probably never heard of is Frigoglass. They are the world's leading manufacturer of industrial refrigeration glass. Hellenic Bottlers is the second largest bottler of Coca-Cola in the world. Greek investors control the largest shipping fleet in the world. So we have a lot of good investors, and what they share is three characteristics: highly professional management, capital discipline, so a real focus on financial standards, and internationalization. Most of these groups are now making about 50% or less of their total turnover from Greece. I will skip that because I think we're running out of time. Investment promotion. This is the plan B. This is, for me, the positive thing which can emerge. We have identified 6 different sectors: energy, tourism, shipping, property, agriculture, and natural resources, where it would be relatively feasible to gain up to 80 billion euro in investment value in the next 5 to 7 years. The main determinant of this is how fast investments can be licensed or approved, basically. This would bring in an initial tax revenue of 7.5% during the investment period, and it would bring in at least 11 billion of tax revenue once the normal operating capacity of these investments has been reached. Before I get there, describing these sectors, what we need to do in addition to the privatization is we need to reform the tax system. And I'll run through these very quickly. The first recommendation is to equalize the corporate income tax of limited liability companies, corporations, and professionals to 20%. That can be done fairly quickly. Reduce Social Security contributions from 44% to 20% in the next 4 years, so a progressive decline or decrease. Reduce VAT to 10% in certain sectors, which are labor-intensive and seasonal, very important. Progressively increase the minimum wage by 100 euro, up to, in other words, 100 euro per month by January 2012. We need to offset the decline in employment and other problems which we have with an increase in consumer spending. We're only going to do that by increasing the minimum wage. The private sector by itself is not going to act, and government social transfers simply don't work. They create waste. We need to implement an international business center and a non-domicile tax status. We already have it. There are so-called Law 89 companies, but they're not promoted and they're not working efficiently. But if we were to take what we already had and simply develop it, we'll be able to attract major investments in areas like shipping, or property development. And I don't say this by accident. I say it because I'm doing a lot of investments which go through Cyprus, and I'm doing a lot of investments which go through the Netherlands or through London, the UK, which have similar tax statuses. We need to reduce tax deductions for certain items like luxury cars to make sure that companies are actually paying their correct tax estimates. We need more frequent tax and labor audits. And I would say that every taxpayer, when they give their tax return, there has to be an automatic matching of what's in the bank account. Really simple reform. How much time? I'm running out of time. Okay. I think this will be online, the presentation. Every sector is basically profiled with some data in terms of the units which can be promoted, the investment value, new employment, etc. I will just go very quickly through one, which is the tourism sector. We have the immediate capacity. I would say we should set a target. We want to increase arrivals. We want to go from 15 million in 2009 to 20 in 2015 to 25 in 2020. We know then we can plan what the revenue will be. We can plan what the expenditure will be. We can plan what investments can be licensed where there is already interest from international or domestic investors, and where we know that the revenue is possible. So I'm sorry, running out of time. I just want to conclude very quickly. There is a very negative perspective or sentiment about Greece these days. Greece has done this, Greece has not done that, whatever. The fact of the matter is we have a unique opportunity in this crisis, and that opportunity is really to reform the public sector in a way that benefits the society rather than a select minority. We know that more time is going to be needed. It's for sure. It's mathematically possible. Mathematically documented, and I think the reason there's such skepticism in financial circles is precisely because the numbers don't add up in the near future. I believe, again, as a taxpayer and as a financial analyst, any bailout in the future should include a voluntary debt maturity extension or rollover, and an open market restructuring through open market bond repurchases. I think this is a common sense condition. It's clear that the government needs to focus on a strategy, on a long term, not just the short term, not just reacting to the crisis, but to put in strategic planning to get by the crisis. And it's clear to me that there's no plan B. We have all invested in one plan, Plan A, which is Greece not restructuring its debt. For me, the plan B is to say, okay, we've done structural reforms, or we're trying to do them in the public sector, but these are not going to work without a major investment in the private sector. And believe me, the investment is possible. My company is now looking at €2 billion of investments in Greece, in power generation, property development, agri-food processing. And I'm sure that if the government took these things more seriously than they have until now, they would start seeing very, very positive results in the very near future. If my company has been able to channel 1 billion of investment into Ukraine, 1 billion into Russia, believe me, the things in Greece are much easier, despite Greece's business ranking. So I'm fairly optimistic. I'm an optimist by nature. I'm also a realist. I see this crisis as a problem to be solved, not as an insurmountable problem. Certainly in the private sector, there have been companies with a far higher debt which have been turned around. Of course, it's a different practice. And if I can just if I can draw on your patience just for one more minute, this is now essentially my 6th crisis that I'm living through since 1996, 97, and any one of you who's been working and who's over 35 has been through the same crisis. In 2007, we had the sovereign debt contagion and the currency depreciations in Southeast Asia, which extended into Russia, Ukraine, and Eastern Europe. 97. Sorry, 97. We lived through that. In 2000, we had the bursting of the dot-com bubble. Believe me, in 1999, every week I was getting a business plan on my desk promising, the revolution of this and the revolution of that because of dot-coms. In 2001, we lived through the burst of the accounting standards scandal. We saw Sarbanes-Oxley passed. Ironically, today we see the same accounting practices being used around the current crisis. The current crisis that we see here is actually three. It's three synchronized crises. The first is the end of bank leverage and unsustainable investments. So it's a financial crisis. The second is the peculiar or the particular impact that this has had on real estate, but also that real estate has played in the banking crisis. And the third one is the sovereign debt crisis. Now, to some extent, all of these are related, but as Miranda showed in her presentations, they're all separate. I heard a lot of talk this morning about new rules, new regulations, try to avoid the problems of the future, etc. If we accept that there have been 6 major crises in the past 14 years, and we have learned apparently nothing from them, I see no reason why in the next 16 years we'll be able to achieve a legal or regulatory environment which will be any better. I think what we need to do is focus again on economic fundamentals. We need to focus on our crisis management capacity, and we really need to prepare for the next crisis, which we see occurring now. We see them materializing, but I'm fairly confident that there are sustainable workarounds and sustainable workouts to all of them. So again, I'm realistic, but also fairly optimistic, and in every crisis, I think there's some very interesting growth opportunities. Thank you.